Welcome back to Cozy Financial Planning, my friends. Today, it's nice and cozy fall weather, and our kids are back in school for a little while. And one thing that's kind of bounced around our heads as parents is definitely how to pay for their post-secondary education. So let's discuss that today. Imagine we had our child just now, and we want to start saving for their education right from the start. So we've set aside $200 in our budget per month to start saving for education. We want to do that for the next 18 years of their life. And so let's look at the three major options available to us as Canadian parents, which are the Registered Education Savings Plan, the RESP, the Tax-Free Savings Account, or TFSA, as well as permanent insurance as an option. At the end, we'll go over an honorable mention of trust, just because they're not as commonly used as maybe they once were. Let's get right into it today, shall we? First up is the RESP. This is kind of a special basket for saving tied to the government, and that's kind of where the magic starts. The government's going to contribute 20% of your deposit, and in our cozy illustration here, we do $200 a month, so total at the end of the year is $2,400. So we're going to get $480 of grant money from the government. At the end of 18 years, our total basket of contributions will be $43,200 that we've just put in ourselves. The government's going to put in $8,640 additional to that. And then if we sit in the middle of the moderate rate of return of about 5% annual return, you're going to be around $76,000 in the account for your child's education at the end of 18 years. Now this is used for schooling, so we can use it for tuition. We can take it out for dorms, like paying for dorms, rent, stuff like that. Now, the downside of this is if they don't go to school or they get a full scholarship or they don't use it all, the grants go back to the government and you will be taxed on the growth. Regardless of whenever you take it out, you're always taxed on the growth, even if it's for the education, but the grants will be given back to the government and then your contributions will go somewhere where you like it to be. There are a few different options. There's some red tape here, but let's not get into the weeds of that. We'll keep it pretty simple as an option. Next up is the TFSA. With the TFSA, the beautiful part about this is it's completely flexible. There are no limitations on this, as in you put into your TFSA and there's no government that's going to tell you what to spend it on or how it has to come out. But the downside is you don't get the grants. So it's just purely on your contributions. If you do put in the same amount of money, the $43,200 or the $200 a month for 18 years, you get about a 5% rate of return to keep it apples to apples comparison. You'll be just about $70,000 in available funds for your child's education. Now the benefit is if they got scholarships or didn't go to school, you don't have to do the same things as you do with an RESP. There's no grants to give back, so you don't have to worry about that. And there's no tax on withdrawing it. So no matter what, there's going to be no tax implications with it. Now, the only thing about it is it's not in your child's name, it is in your name. And so you can't be using your TFSA for anything else. You have to kind of put it towards this or open one for this now that the amount is so high. Start it as an 18-year-old if you're in your mid 30s or 40s, right? If you haven't used it, you have a lot of space to use up. And the $200 won't get ahead of that. The other benefit is even if they do go to school or anything like that, you can take it out and give it to them for other reasons. You can give it to them to purchase a house, purchase a car, or just be a nice little graduation gift for them. That is an option with the TFSA compared to the RESP. The third option, as I mentioned, is permanent insurance, usually used with universal insurance or whole life insurance. Now, there's two parts of this. It is a little more complicated. You have an insurance portion and then you have the investment portion. Both whole life and universal have investment portions. Universal has a little bit more control. Now, what happens is when you pay your premium of $200 a month, some of that's going to go for the insurance portion and some of that's going to go to the cash value of it and grow the policy. After so many years, it's paid off, and then you can actually gift that to your child for other uses. But you can borrow against it to pay for education. It's flexible like the TFSA in that. The money can be used for anything else. You can get the cash value and cash it out after 20 years. Whatever that amount is, and the policy is no longer in effect. You do not get grants like you do with the RESP, just like I mentioned. That's the only option available with government help. The money that would be in this is roughly, it's a lot more complicated to get to, but roughly maybe $55,000 to $65,000. So it is the least amount of cash available to you, but you still have the flexibility of it. Now, the other benefit is that you can also, as I said, you can pay for anything with this, as well as they already have life insurance. It's actually a very good tool that's for succession planning It's a little more complicated than the other two. It does take a little more nuance and a little bit different of an option. And once again, it's kind of like situational for you and your family. I am a believer in it as long as I'm a believer in all three. If we do a side-by-side comparison of them, the TFSA is probably the most average one for a lot of Canadians. The RESP, I believe, is a great option if you especially need the grants to help you out, and maybe you can't afford the $200, it's $100 you could put in. The numbers will all kind of line up the same way if you do the same. And then, but you do have to be very disciplined with the TFSA and the whole life policy, essentially, to make sure you're always paying your premiums for that, so it doesn't go into default. And the TFSA, so you don't ever touch it, right? Because you have access to it, unlike the RESP. You don't really have access. You have to jump through hoops and paperwork to get it done. The TFSA, you just have to unlock it. Like the bank or the institution you're with, they don't care that it's earmarked for your child's education. They will just give you the money because you are in control of it. The honorable mention is trust. This is not something that I normally dealt with a lot. There is a lot of red tape and a lot of paperwork to these. They're a little more complicated, similar to the life insurance. If you want something more straightforward, the TFSA and the RESPs essentially are a lot easier to handle than these options. The reason why it's an honorable mention is just because it's just not consistently used. You have 3 really solid options. As I was saying earlier, if you really need the grants or something like that, the RESP is a very good option. And then your TFSA is probably, in my opinion, probably the 1A option, and RESPs are probably 1B. And then life insurance is a little more complicated. It doesn't have the grants like the RESP does. It does have the flexibility to it, but it is the least amount of money. It just happens to be that something that you could do well into the future. So if you think you want your kids to take student loans for any particular reason, or if you feel like they're gonna get scholarships or grants, not go to school, or potentially just pay for themselves, or you have extra money, those are also another option for the insurance side of things. Now, I want to say thank you once again for watching one of my videos here at Cozy Financial Planning, and I look forward to seeing you in the next one.